Adventures, and I want to thank you guys very, very much for getting on this call in the middle of the afternoon to talk a little bit about something near and dear to my heart. And just as we kind of finish up 2023, we've always been really involved in ongoing education, and anytime we can find a subject matter that we think is of value to our friends, our family, our investor base, we try to bring experts in and discuss, hey, what is this? Or at least introduce it to you. And the one we're working on today is self-directed IRAs. And the one that we're going to do probably towards the end of the year is another one that I'm really passionate about. And that's really more on the health side, kind of combining health and wealth. So look for some information on us on our GBB, our kind of good, better, best series, that we're going to do something on the health side. We're working on that. And especially all of us that are 50 plus, I think it's really important that we start, if you haven't already, start focusing in on the health. But for today, let's get to the self-directed IRAs. This is one that I mentioned is near and dear to my heart. I'll tell you, I was not aware of this platform or this vehicle to actually take IRA or 401k money, which is what happened to me back in around 2000, and put it into an IRA and figure out how to invest it in something other than the stock market. And sure enough, I'll give you a quick story. I literally had a chunk of money when I got out of the high tech world, and I'd gone 3 different companies and just kind of rolled it. And then I decided I'm going to be an entrepreneur. And I went ahead and said, what do I do with that money? And it was so limited in what I could do with it. I was just so frustrated. If you guys remember the .com bust, I was unfortunately heavily invested into the tech sector because that was my background. And I saw my options for investing. I just didn't have any, so I didn't know what to do. Sure enough, I just started researching and I learned about the self-directed IRA. And I can tell you this, it allowed me to take a chunk of money that was not available to me through my old 401k program, put it into a self-directed IRA, which ultimately gave me the capital to start investing. And kind of launched me into the world of syndication and private equity and real estate and commercial real estate. So I give this vehicle a ton of credit for allowing me to kind of leapfrog into the next chapter of my life, which obviously has evolved to where we are today in Presario Ventures. So that's my little story behind it. So I'm a huge fan of this product, and I want to bring on our guest expert, Bill Neville. Bill's with Interest Group, based out of out of Oakland in the Bay Area, and has been with Interest for about 12 years plus. Bill has spent the last 12 years really on the business development education side, and is visiting with him. We always talk about education and how do we just get the message out there and give people options, and that's exactly what Bill does. So we're excited to have Bill. We're going to spend about the next 15 to 20 minutes. He's going to go through some of the key points in the self-directed IRA. We will have about a 5 or 6 minute Q&A at the end. If we need to go over, we sure can, but we're just being mindful of your time right here in the middle of the day. And for any of you that cannot stay on the whole time, this is being recorded, and we will have access to this later this afternoon or first thing tomorrow morning. We'll have a link for this recording. So with that said, let's get started. And I'll bring Bill on here in just a second, but a little bit I want to share with you guys about real quick about Presario. Some of you may be new to us, but just a little update. That's our team in the top right. Presario's been here almost 9-10 years now, with Tom and I starting the company. We've grown into a very efficient team. I want to show you over to the left what we do there is, and that's been our model, what we've done for investors. We've had a 2.6 multiple. And our average hold time on any one of our assets is a little over 4 years. Now, times are changing, and we'll get into that later at a later webinar that we're doing on the assets and the business model, but a little bit on our track record. And then some of you did ask about a project that we have coming up, probably in the mid-November timeframe, maybe late October. We are not going to spend really any time on that. We have another webinar coming in about 3 weeks called Paloma Luxury Apartments, but this is a Class A asset we're looking to acquire in Northeast Austin. But some of you did ask about that. We're not going to spend any time, but that's the asset we'll be talking about in 3 weeks on a different webinar. So with that said, I'm going to turn it over to Bill. Bill, are you ready?
I'm here.
All right. Okay. I'm going to kick it off. And so, Bill, I've already introduced you, and I'll let you take the mic from here.
So just a little bit about Entrust. We are custodians and record keepers for what are called self-directed retirement accounts. I'll explain exactly what those are in a minute. We're one of the oldest companies in our space. We've been in business for over 42 years. We currently have a little over 24,000 accounts, and we hold over $5 billion in investor assets. This is what we're going to be talking about, specifically investing in private equity in a self-directed IRA. Well, I'm required to put this up every time I do, talk about self-directed IRAs. And in short, what it says is that if you are thinking about making any investments, Entrust as a custodian does not provide advisory services. So before you make any investments, we encourage you to talk to advisors, CPAs, tax attorneys, anybody like that who you would consult, but Entrust as a company does not provide advice. So this is what we're going to be talking about real quick. I'm going to just talk about the Entrust group and what exactly is a self-directed retirement account. Then what is a private placement? I think I removed the slide about the offering memorandums because that's not necessarily applicable here. Quickly explain about prohibited transactions and disqualified persons, and then how would you invest in a private placement inside a self-directed IRA, and then finally we will take any Q&As, questions that you have. And to be clear, any questions about like self-directed IRAs, this is going to be focused specifically around investing in private equity. Like Presario, but if you have questions about investing directly in real estate or metals or doing notes or whatever, I'm happy to answer those questions as well.
Yeah, Bill, I'm glad you said that, because even though we are focused on private equity because that's what we do today, guys, there are other options out there. So I think that's important that we at least disclose that to you guys and make you aware of it.
So just a little bit about Entrust. We are custodians and record keepers for what are called self-directed retirement accounts. I'll explain exactly what those are in a minute. We're one of the oldest companies in our space. We've been in business for over 42 years. We currently have a little over 24,000 accounts, and we hold over $5 billion in investor assets. So, what is the term self-directed IRA? It means basically two things. One, you make all your own investment decisions. So Entrust does not sell you investments. We don't promote or recommend or endorse any particular investment, right? And you're not limited to just stocks, bonds, and mutual funds. You can invest in almost anything you want inside a retirement account. And I'll talk about the few things that you can't invest inside a retirement account. So in short, when you have an IRA or a 401k or a 403b or a pension plan or any type of retirement account, it requires that account to be held by a custodian. Most people's custodian is a bank or a brokerage firm, like a Merrill Lynch, a Charles Schwab, a Fidelity, companies like that. And those firms will typically limit you to only investing in exchange-traded stocks, bonds, and mutual funds, or from a very specific list of funds that they offer to you. But the IRS doesn't limit you. The IRS says you can invest in pretty much anything you want. You can invest in real estate. You can invest in private equity. You can invest in private debt. You can invest in promissory or precious metals. You can invest in crypto. Digital currencies if you want to. You can invest in almost anything you want, but you have to have your account with a custodian who is willing to hold those investments. So the self-directed IRA is not a type of account. It's a description of the service that we provide. So if you have an account with us, you would still establish either a traditional IRA or a Roth IRA or a SEP IRA or a 401k. So the contribution limits, the distribution rules, all those things with an account with us, with a Roth or traditional with us, is no different than a traditional IRA or Roth IRA or whatever that you would have with Merrill Lynch, Charles Schwab, any company like that. The only difference and what makes it self-directed, again, is one, we don't provide any of the advisory services. We're not a fiduciary in that we don't give you advice, whereas Merrill Lynch, Charles Schwab, Fidelity, companies like that do. And two, we don't limit you just to stocks, bonds, and mutual funds, which Fidelity, Merrill Lynch, Charles Schwab, and companies like that, they limit you. They're not willing to hold things like rental properties, private equity, et cetera, et cetera. So these are the types of investments that are allowed. And I've mentioned a lot of these: private placements, which we're going to be talking about, rental, properties, either single family, multifamily, commercial property, notes, precious metals. I'm going to take you directly down to the bottom bullet there. It says almost anything. And that is really true. We had somebody invest in cattle in an IRA with us, in an airplane, in a bowling alley, in a racehorse. Like, people, you can, as long as it's for investment purposes only, you can invest in almost anything. Now, what can't you invest in? Go ahead to the next one. These are the only things you're not allowed to invest in inside a retirement account: collectibles, life insurance, and corporations that are structured as S corporations. So you can invest in an LLC or a limited partnership or a C corp, but you can't invest in S corp. You can't own life insurance inside your retirement account, and then anything that's defined as a collectible. So the examples we use there: work of art, a rug or antique, metal with a little asterisk, and that you can invest in certain precious metals, which are gold, platinum, silver, and palladium. Those are, but they have to be a certain purity, right? You can't own coin collections. I had somebody just the other day email me. They asked about investing in Pokemon cards inside their retirement account, asked if they could do that. My response is no. I believe that would fall under a collectible. We mentioned alcoholic beverages. So you can't own, for example, wine inside your retirement account. However, you could use your retirement account to invest in a winery, right? So just to understand the difference, wine itself would be a collectible, but investing in a winery would be a business that your IRA is allowed to invest in. So there are certain people that are considered disqualified persons with a retirement account. That's you as the account holder, your spouse, your ancestors, your lineal descendants, spouses of your lineal descendants, so children, grandchildren, and then somebody who might be considered a fiduciary. So what does that mean? Example, for example, if you had you wanted to invest in a rental property, you can't buy a property that's already owned by a disqualified person, right? So your IRA can buy rental property, it can own investment property, but it can't purchase that property from a disqualified person, right? It also can't sell a property to a disqualified person. You also can't necessarily use your IRA to invest in a business that's already owned by a disqualified person. So if you have, let's say your kids or your parents owned a business and they were looking to raise capital and looking for investors, you wouldn't be able to use your retirement account to invest back into that. Actually, I shouldn't say your retirement account. You can't invest your IRA, potentially your 401k. So there are rules around prohibited transactions and disqualified persons that are potentially important for you to know, depending upon the type of transaction that one occur. So this is the definition specifically when it comes to investing in private equity or private businesses. So what is considered a prohibited transaction? So if you want to use your IRA to invest in a business where you already are at least a 50% owner of that business, your IRA can't invest in it. So a disqualified person would hold greater than 50% share, or if the investor is a officer, for example, of the investment. So if you work as a CEO of a company, even if you don't own up to 50%, you'd probably be prohibited from using your IRA to invest back into that business. I will add a caveat. There are different rules associated with investing from a 401k. If you are a business owner and you have a 401k under that business, you can potentially invest that 401k back into that business under what's called rollover for business startup ROBS. I'm not going to get into too much detail, but I'm specifically talking about when you're investing an IRA into a privately owned business, there are rules around your relationship with that business and other people who might be disqualified persons to you that might prohibit you from investing in that business. It's essentially any kind of equity or business that's not publicly traded, we call private placement. They're not required to be registered with the SEC. They're often used by companies to raise capital, and we're specifically talking about startup companies. Now, in this example with Presario, What they are is they're structuring it, and this is very frequent. It's probably the most investment type that's held inside a retirement account, where there is a company out there that is raising capital that they're going to turn around and invest in something like maybe an apartment complex, right? Or some commercial property, or maybe storage units or something like that, where you're investing your IRA into an LLC. You become a percentage, your IRA, or you personally become a percentage holder in an LLC. And then that LLC is turning around and investing in something, right? And again, it could be crypto, it could be real estate, which Presario focuses on. It could be like they could invest in other businesses, other startup companies. But essentially, what your IRA is doing is it's becoming a percentage investor into an LLC, into a business, right? And so that's considered, from a transactional standpoint, a private placement with us. Now, I get a lot of people call me up and say, I'm using my IRA to invest in real estate. And what they're actually doing is they're investing with a company like Presario, where they're investing in an LLC, and the LLC is investing in real estate. We don't perceive that as being a real estate investment. We perceive that as a private placement investment. For us, a real estate investment is when your IRA holds direct title on a property. The IRA is going to own the real estate directly without an LLC being a pass-through in between that transaction. And it's up to, just, you don't have to go back, but the last bullet point, it's up to the investment sponsor, in this case Presario, whether they require their investors to be accredited or non-accredited. That is not a rule that Entrust as a custodian puts in place. So if someone, like anybody, can open an account with us, whether you're accredited or not accredited, and you can invest in real estate or you can invest in a private equity. But if that private equity requires the accredited investors only, then the individual has to qualify as being accredited in order for them to use their IRA to also invest. So why would a company, raise capital from a self-directed IRA? So oftentimes, and again, we're talking primarily about startup companies as an example when we talk about private placements, but oftentimes raising capital from individual investors, including self-directed IRAs, is oftentimes simpler and faster than getting money through a bank loan. As an investor, you're potentially getting a higher return than you might get if you were just investing in some exchange-traded fund or some publicly traded stock. However, typically with higher returns, there comes higher risk, right? So just bear in mind, anytime that you're investing in something that is not necessarily exchange-traded, which might incur a higher potential for return. Investing in a startup company often has a potential for a higher return. There's also a greater risk. And there is, the SEC does have some educational material regarding investing in private placements. So you might want to check out their website and read up on their bulletin that they have on it. We do recommend, again, it's your responsibility as the account holder to do your own due diligence. It's not something that Entrust as custodian provides for you. If you want to invest in some kind of really anything, but again, talking about private equity, here are some of the things that we recommend. Beware of promises of higher returns. Make sure you do a background of any of the company principals. Make sure you get copies of any written materials, things like offering memorandums and contracts and things like that. Make sure you know, if you are investing in a private equity, if at some point you need to access those funds, whether you're doing it from inside or outside the IRA. For example, if you are coming up close to required minimum distribution age and you feel like at some point you're going to have to start taking RMDs at the age of 72, find out like what's going to be the requirement if you want to liquidate and be able to withdraw cash. What's going to be your ability to be able to liquidate that holding? And then we mentioned research return policy. What we're talking about that is if you want to basically sell your ownership or title or shares back to the private company, make sure you understand what that process would be. So that's just some things we recommend, because again, it's your responsibility as the investor to do your own due diligence. Entrust does not do that. We're just the custodian and record keeper on behalf of your retirement account. So what happens is, when you're using your IRA to invest inside any kind of investment, and we're specifically talking about private equity, or in this case, your IRA is going to purchase a percentage ownership into an LLC, right into a Presario Ventures offering, where they're structuring as LLC, they're bringing in different investors, you become a percentage owner inside the LLC. the subscription or operating agreement must be submitted to the custodian for processing, because the investor, if you're using your IRA, the investor is not you as a person. It's your retirement account that is the investor. And standard naming convention for retirement accounts is some version of custodian name for benefit of, and that's the FBO you see in the bullet point there, the custodian name for benefit of the account holder's name and their account number. That's the name of your IRA. So that's going to be who is the investor. The custodian is the signatory on behalf of the IRA. So when you want to use a retirement account to invest, you open an account with the custodian, you transfer rollover money, and then you instruct that custodian to process the investment on behalf of your IRA. You do that with the private equity by submitting their investment agreement, either a subscription agreement or operating agreement. We ask that you sign, read and approved as the IRA holder, but we are the signatory on behalf of the IRA. So you submit it to us, we review it, we sign it, we send the money directly to the investment sponsor. So if you were investing again with the Presario offering, you would submit their agreement to us in the name of the IRA. We would send the money directly to Presario. Now your IRA would own that holding, would own that syndication or that fund, right? So any revenue, any dividends that's getting paid, or if it's a buy and hold and they're paying out after they flip the property or something like that, all that payment gets paid directly to your IRA. Your IRA owns the property. Your IRA receives any income. Your IRA pays any expenses if there are any expenses. If your IRA holds direct title on a property and you have maintenance, the IRA has to pay those maintenance. The IRA receives any income. And that's how it continues to stay tax sheltered, in that the whole transaction occurs within your retirement account. Go ahead. I think I've, I just mentioned that. All revenue and expenses flow into and out of the IRA. There are, as we go back to the prohibited transaction rules, right? Your ability to use an IRA to invest in a private equity could be affected by your own personal investment into that offering, as well as potentially your relationship with any company officers. So for example, if it's your children or parents that are owners and officers in that company, it might affect your ability to do your own IRA investment into that company, right? Because there are prohibited transactions and disqualified persons rules.
Yeah. Hey, Bill, I want to point out one thing on this slide. We've done hundreds and hundreds of these for our investors over the last decade. And I want to make sure people are aware that we can help in this process. So I know you look at it sometimes, new investors go, "Oh, that's a lot for me to understand." Well, between your customer service and our director of client services, we make this processing really smooth and easy, especially easy to understand.
Yeah, Presario obviously has IRA investors, so they understand conceptually this. So they're not going to submit the operating agreement to you or the subscription agreement in your personal name when they know it's an IRA. They already know it needs to be structured in the name of the IRA. But we wouldn't process that. I mean, we would reject it. We'd send it back. We would tell you what needs to be corrected. So as he mentioned, like, you've got basically two people potentially holding your hand to walk you through the process. So how do you do this? One, you just simply open an account with us. You can go to the entrustgroup.com. We do have a $50 new account fee that I'm happy to waive for anybody who is part of this. I would have to give a promotion code. So at the end, you're going to get my contact info. Before you necessarily go right to open an account, reach out to me so I can give you that code to waive the fee. But we do have an account opening process at the entrustgroup.com. It takes maybe 10 to 15 minutes to get an account established, just your name, address, social security number, date of birth, type of account. Pay the $50 fee or use the promotion code and your account's established. You can have it in no time. The next step then is you have to fund your account. You have to either transfer or roll over money from your current custodian, whether it's an IRA or a 401k or a pension plan or 403b, or make an annual contribution. But there are contribution limits, so bear that in mind. Depending upon the type of account that you have, that can be as low as $6,000. But if it's an employer-sponsored plan like a SEP, then it's much higher. You can get up to around 60 grand. As a contribution. And then choose the type of investment you want to make, and then instruct us to make that investment, right? Submit your purchasing agreement, your subscription agreement, the operating agreement. If it's actual property, you would submit the purchase invoice along with all the closing documents. If you're investing in metals, it would be an invoice from the metals dealer. If you're doing debt, it would be the note the borrower. So depending upon what type of investment you're doing, you submit that investment agreement to us, instructing us to process that investment out of your IRA.
Okay, let's go, Bill, if we can. Let's go to the Q&A and take it. And I actually have two questions. But let's see. I'm going to go to the first two we have here. Can you roll over existing solo 401k assets into self-directed IRA?
You can absolutely roll over from a 401k into an IRA, but bear in mind, depending upon the 401k plan. So a 401k plan is an employer-sponsored plan in which you're subject to the rules of that plan. And if you're still working for the company or part of the company that is providing that plan, then you want to see what the plan documents say about your ability to do what's called an in-service distribution, because the plan has to allow for you to do that. Now, you mentioned specifically a solo 401k as opposed to, like, I work for the Entrust Group. We have a company plan, so I'm subject to the rules of the company plan, right? But for a solo 401k, that's only for business owners and their partners in the business, and then spouses. So I'm guessing if you're talking about a solo 401k, you have one for your own company. You are the trustee of your plan. So if it has restrictions about the ability to do an in-service distribution and roll over to an IRA, then you potentially can talk to the plan provider about changing that in your plan, right? So, but if it's an old 401k, not part of the company anymore, then you can just roll that over. That's more typical when you're working for a company where you're just an employee of a company and they're providing a 401k for you. While you're still working for the company, the likelihood that you can roll over from that 401k to an IRA is not great. They aren't great. It's usually you need a qualifying event to happen, such as the main one being you leave the company. But also reaching age 59 and a half is also a qualifying event that allows you to roll over while you're part of the company. But again, in this example, a solo 401k, for any 401k, find out what the plan allows for in-service distributions or in-service withdrawals.
Okay, next question I've got, timing, meaning from the time you open the account until it's funded, until you can invest. What is that typical timeline?
It depends. The biggest part that depends upon is how long it takes for you to roll over or transfer from your current custodian. And that can vary pretty dramatically between custodians or among custodians. Like some can move the money as quick as 2 or 3 days. Others will take 2 or 3 weeks. On average, what we typically see is that transfer or rollover to take is about 5 to 7 business days. So from that standpoint, it takes about 10 minutes to open an account. You transfer a rollover in 5 to 7 business days. Our turnaround time to process your investment is 1 to 2 business days. So 1 to 2 weeks is possible. That would be relatively fast. And it really does require your current custodian that you're moving the money over from to be on top of things and process your transfer, process your rollover, within a relatively short period of time. There are some that are notoriously slow that take like 3 weeks, 4 weeks sometimes to move the money. And we don't have any control over how quickly they move the money, right? So that's going to be the biggest determining factor between it being relatively quick and being pretty slow.
All right, next question. This is really good. It's a technical question, so I'm going to and it's really good, but I'm going to ask you to try to make it really simple. Okay. Can you talk about UBIT and different taxes related to the investments in the SDIRA? Because this one comes up quite a bit.
Yep. So unrelated business income tax, or the other side of the coin, when you're primarily talking about unrelated debt financed income tax, they're kind of the same thing, but they're applicable in 2 different ways. UBIT is if you're running a business inside your IRA. Let's say your IRA invests in, I don't know, a Burger King franchise, for example, but it's not just an investor. Your IRA actually is running that business. Your IRA is paying the employees. Like, it's not just an investor where it's like almost like Presario is doing, where they're raising capital. But in this example, Burger King's probably not a great example. Let's say you bought, I don't know, a Mary Maid's franchise, for example, and your IRA is paying all the employees and your IRA is receiving all the revenue and your IRA is running a business. It is going to be subject to a tax called unrelated business income tax. Essentially, the IRS says you don't get to have this tax advantage against other competitors of yours or other Mary Maid franchises by avoiding the tax. So it's taxed at trust rates. But what I'm going to really focus on is what's called unrelated debt finance income tax, which is same as UBIT, but the application or the reason for it is different. UDFI is used when your IRA is borrowing money to invest in something. So usually it involves investing in real estate. So I'm going to give you a real quick example and tell you how it's calculated and the reason for it. So let's say your IRA is going to buy a property valued at $200,000, right? And your IRA has $100,000 and is going to borrow the other $100,000. So your IRA, there are lenders that will lend money to your IRA. Your IRA can borrow money. So the IRS looks at that. Okay, and so your IRA has $100,000, it borrows $100,000, it buys a property for $200,000. Let's say at the end of the year, right? Let's say your IRA gets $20,000 in rental income, in net rental income, right? Let's say it comes in at $20,000. And at the end of the year, that loan amount is 50%. What the IRS looks at that and they says, okay, of that $20,000, 50% of that was funded by the IRA. The other 50% came from money outside the IRA. It came from borrowed money. That means that 50% is not tax sheltered. Your IRA has to pay a tax on the 50% that came from the borrowed money because that wasn't tax sheltered money. It was outside the IRA money. There is a tax table, a trust tax table that calculates what that tax would be, right? And it's graduated just like our income tax, right? It starts at a certain dollar amount, up to this amount is at 12%, then this amount is 18%, this amount is 22%. I don't know the exact amounts. But essentially what's going to happen is they're going to look at that $10,000 and say, okay, like the overall rate is, let's say 20%. So now your IRA is going to have to pay a unrelated debt finance or UBIT tax of $2,000 on the $10,000 that came from outside the IRA. So instead of getting a $20,000 net return for that year on your investment, it got an $18,000 net return, right? Because it had to pay a tax on the portion that was funded by your IRA. Now, where that can potentially come into effect with an investment like Presario is if Presario is raising capital from individual investors and then also borrows money, right? So if it's combining the two where it's raising capital and it's also borrowing money, and so let's say your IRA is a 5% holder in their syndication in their LLC, and they raise capital up to a certain dollar amount, let's say again 50%, and then the other 50% is borrowed, that at the end or in a year, if they pay you a dividend, a percentage of that could potentially be subject to unrelated debt finance income tax, or UBIT in the term that you use. But that would be something that you'd want to talk to about a CPA, and Presario would also be able to provide those figures as far as how much is leveraged or not. Also bear in mind that as the loan gets paid back, that percentage drops, right? So in the example that I gave you where somebody buys a house and they borrow 50% of the money, and let's say they're paying the loan throughout the year. And let's say at the end of the year, they've paid it down to where now it's 40% rather than 50%. That UBIT or UDFI is going to be now calculated based on a 40%. Like, so the same $20,000 comes in, but their loan is paid down to 40%. Then 60% is going to be considered, within the IRA. 40% is going to be calculated as outside the IRA. So now that in that $20,000, 40% of that would be subject to the UDFI, not 60%.
Okay.
I hope that helps.
Yeah, that was very good. And guys, when you get to the UBIT with a private equity or syndication model, we can help guide you to the right information. We've done a few of these. 2 minutes for two more questions, and I think they're both pretty straightforward. One of them is on depreciation. Oh wait, hang on. Here it is. Actually, I have three, but I'm going to run through these. Is there any advantage of depreciation when the asset is held in your SDIRA or 401k?
No, you can't depreciate.
Okay.
Because an IRA doesn't file taxes, right? And so you depreciate a property when you own a property and you're generating rental income, and then you offset expenses against that, right? IRAs operate purely on a cash basis. You don't get to write off expenses on your taxes because you don't own the property. Your retirement account does. So an IRA doesn't file taxes, so it doesn't write off depreciation. You don't get to depreciate.
Okay, I think this one is pretty straightforward too. Kind of following up on that question on the UBIT, but this is when is there a tax if there's a sale of the property? So we go out and have a disposition, we pull all the profits in, we push out all the profits to the equity investors. Is there a tax at sale on the property, or just is it treated like ordinary income? Is the question.
Neither. The IRA receives the proceeds of the sale, and until you start taking distributions of from your retirement account, there is no tax consequences. The IRA bought the property. The IRA makes an investment of $100,000. The IRA receives a return on investment of $150,000. You just grew your retirement account by $50,000. Until you start taking withdrawals, you aren't taxed. And then when you're taxed, now you've grown it by 50,000, and let's say in a year you decide to take $10,000 out, you're only taxed on the $10,000 you withdrew. Now, withdrawals from retirement accounts are taxed as ordinary income. So it gets added on to whatever other income you might have, whether it's Social Security or a job or anything like that. But I mean, it's the
sale of the property
transaction doesn't generate a tax, right? Only a withdrawal from your retirement account generates a tax, and you have the flexibility to determine when you want to take a withdrawal and how much.
Okay, and this last one, Bill, I think is directly at your company. Okay, what happens to funds in an account that have not been invested yet, or income that has come back to the account? So they're going to hold money with you.
Yeah,
you provide more liquid investments.
So we don't provide investments, period. We're just a custodian and record keeper, right? We are not a brokerage firm. So when you go to a brokerage firm, they'll give you a list of funds to choose from that you could potentially invest in. Entrust does not do that.
But you're not like a treasury bill or a savings or a CD or anything like that, right?
No, any cash that's held is ours to generate interest on. That's part of how we keep our fees so low, is that we get to put the interest in the money into CDs, and we keep the interest on CDs. That being said, if you want to put it into something like some kind of a fund or a stock, right now we're between trading platforms. We used to have a trading platform that we provided that allowed people to make those types of investments, to park their money while they're looking for their next investment. Right now, we're in the process of adding a new trading platform. In short, we don't have anything like that. But once we have that, once we get it installed, you'll have the ability to go in and process a trade into like some kind of fund or even a money market fund or something like that. But you have to know what the fund or stock is, right? Like we don't provide a list of things for you to invest in. If you want to put it into some kind of money market fund, like a Putnam fund or something like that, you'd have to go find that fund and then come in and enter the QSIP or the name of the fund. The trading platform will bring it up, and then you can invest in it and have it summary temporary. But again, we don't provide investments. You specifically said, do you provide more liquid investment options to park such money? We don't provide investments at all. We're a custodian and record keeper only.
Okay, so we've got one more question. I'm going to hold off on this. It was talking about age. Is there an age appropriate time to be? Am I too old, too young? On that. I'm going to give this one a quick answer. For the person that asked that question, we're pretty close to the same age. I still like this for what I do, and maybe we can talk offline, but I don't think, unless you're 75 or 80, it may not be something you're looking at, but to me, it all depends on the investment. It's up to you. You may have an investment that lasts 2 years, 5 years, 10 years. And I think that's more of the direction that you should probably be looking at, unless you, Bill, think there's another answer to that. So,
I mean, the only thing I would say in answer to that question is, required minimum distribution age for traditional IRAs pre-tax accounts is 72. It doesn't apply to Roth IRAs, so it doesn't matter as far as Roth IRAs. So but the thing is that even if you hold a non-liquid investment and you reach age 72 and you're subject to required minimum distributions, you can still take distributions. You can just take a percentage of the asset as an in-kind distribution instead of taking cash. So if you're reaching a point where, again, the caveat would be is if you're at a point or you're reaching a point where you're going to rely on cash coming out of your retirement account in order to make investments, in order to live on, to pay your bills, then you might want to you're going to want to consider the liquidity aspect of any investment that you make. And this is not unique to self-directed IRAs, although like self-directed IRAs are the only ones that are going to typically hold investments that aren't easily liquidated, like a stock or a mutual fund. So that would be my only caveat, is if you feel like at some point in the relatively near future, you're going to be needing to take cash distributions in order to pay your bills, then you want to consider whether an illiquid investment or a not easily liquid investment inside your IRA is the right investment for you.
Okay. Well, Bill, thank you guys. We ran over, but those are some really good questions, very thoughtful questions too.
So there's my specific phone number and my email address. So don't hesitate to reach out to me. And again, we have our fees. Somebody had asked about the fees. We have our fees on our website, or you can just reach out to me and I can detail the fees. They're not much. I mean, depending upon the dollar amount, it could be as low as $200 a year.
Yeah. So, and last thing I'll say here, guys, is we are the second week of October. We are going to be presenting this opportunity, this apartment complex. It's a Class A multifamily deal in Northeast Austin. And, the reason that we like this so much is the economics and the metrics are telling us that we're kind of in this this lull right now. And if we can capitalize on getting a property at a discount, lock in some money, Class A asset, it's already cash flowing. We're buying this at a very, very deep discount compared to another comp just right down the street. We're buying it far cheaper than we can build it. So we're pretty excited about this asset. So we'll be presenting this in about 3 weeks. I think that second week of October. So if you haven't gone to our website, and if you to register for our newsletter, or you would like to see opportunities come your way, please do so. And I'm going to pull up that info at Presario Ventures. That is where that'll go straight to Robin, who is our Director of Client Services. So, and again, 3 weeks from now, we'll be talking about this investment opportunity and what we're doing to move forward with it. So, guys, thank you very much. Bill, thank you. I appreciate your time.
Thanks for having me.
And really, guys, we appreciate you. I had some really good questions. And again, we're going to do the webinar, and then probably in late November, early December, look for a health and wealth seminar with some more education. Thank you, and we'll talk soon.
Thanks, guys.
Bye-bye.